I think we made a low on October 12th. I thought that back in late October. The bond market peaked on October 24th. The dollar peaked around that same time. I think we have to look beyond the United States for starters and see that there's more and more evidence that the global economic outlook is a lot better than people had feared last fall. Europe looks like they're not going to have a recession. China looks like it's coming out of its COVID funk, or at least there's lockdown situation. And meanwhile, when we come back to the United States, there's still a big debate about soft versus hard landing. And I think the economy is going to grow. It's going to grow slowly, but I don't think we're going to have a recession. And I think we've already been in a recession for the past year. It's just been a rolling recession, hitting different industries, different sectors at different times.
Eric, I mean, not an unreasonable point of view, at least on the surface, and you really haven't wavered much lately. You know, that stocks are on borrowed time, and it's all going to fall apart at some point. But what about Ed's argument here?
Yeah, so thanks for having me. So I think the important thing is to go to the numbers. And, you know, right now, the market is trading at 18.4 times 2023 estimates. Those estimates, I think, are far too high. But if we put that aside, 18.4 times is a 50-year high, X the two bubbles, post-COVID and the internet bubble. So you have to believe that we're going to go into a third bubble in order to get valuations such that you actually have upside for this market. Right now, the earnings yield of the S&P 500 is about 5.4%. Money market yields are 4.5%. It's about an 80 or 90 bip spread. That's the tightest spread since July of 2001. One of those bubbles that I was referring to. So the argument for a soft landing, I think, is it's possible. It's unlikely based on what the yield curves are doing, the leading economic indicators are doing, the lag to the 500 bips of Fed hikes we just had. But it's possible. But my question would be, in that soft landing scenario, what are the earnings in 2023, and what's the multiple that's going to be put on those earnings?
Ed, how would you answer that?
Eric is absolutely right about 2023. I think that earnings are going to be basically up from last year, but it's very controversial. People are talking about $200 per share or less for the S&P 500. I'm at 225. The market is about 229 right now. Not the market, but the industry analysts. I think the market looks ahead, and I think it's already looking ahead into 2024. And 2024, I think, will be a good year. Nobody's really talking about it at this point, but I think it'll be a good year. And I think earnings are going to be $250 a share. Every single day of this year, as we approach the coming year, we're going to give more and more weight to 2024. And that's looking pretty good. At $250 a share, I think, is a reasonable estimate for next year. And in terms of the valuation multiples, I think right now earnings have been weakening somewhat. I think we're going to have flat earnings, not hard landing, declining earnings. And I agree. I mean, I'd be a lot happier if the multiples were 8 to 10 and we were starting there. But it is what it is. It's a soft landing. I think what the yield curve is saying is that inflation's coming down. Yield curve in the past anticipated financial crises, credit crunches, and then recessions. This time around, I don't see a credit crunch. I don't see a credit crunch causing a recession. And I think the market is basically looking at inflation continuing to come down.
Eric, I mean, I've got, yes, the yield curve is inverted. We know what that traditionally means. Yes, the leading economic indicators are telling a difficult and perhaps stormy story. But on the other side of that, I do have a consumer that I'm sure has surprised you in its resiliency, at least to this point, that maybe this recession, if it even is one, doesn't look like ones of years and decades past. And that's what keeps us chugging along to the degree that Ed thinks we can, and the stock market doesn't fall apart as a result.
Well, I think the recession doesn't need to be a deep recession for stocks to go down a lot. That happened, if you look at the recession back in the internet bubble of 2000 to 2003, that wasn't a deep recession, yet stocks went down 50%. And the issue that we have right now is that because of the multiple of stocks, just to go to the average, if you go to a 15 and a half multiple on the S&P, you're talking about down about 20% from here. And that's not even counting the fact that if you look at earnings estimates right now, it's not like earnings estimates are trough estimates. we are well above trend. If you draw a trend line over the last 20 years of earnings, we are well above trend, operating margins well above trend. And so those estimates have significant risk to the downside. And by the way, we've been talking about this for 6 or 9 months. And over the last 6 or 9 months, they've been coming down. And we think that they have a lot more to go. And the other point I would make around the Fed is that, yes, they are almost done. Okay. But the issue is, saying they're done, if they were to raise rates tomorrow to 10%, but say we're done, well, that's not good news. And so the point is that, yes, they're going to be done. They're going to finish at 4.75, 5.25. But that kind of Fed funds rate of 5% for many months and quarters to come, that's very problematic for multiples. And that's going to be a big headwind for the economy.